silver won't just, sit here or go down. Could go to 100 and maybe more if gold's going to go another 1,000 or so. So if someone came to me and said, should I buy silver? I'll say no, because you should never buy an investment where you don't know. You've got to, even if you're wrong, you have to intrinsically know to put your capital at risk. But I see the logic for 120. I see the logic for 200. After 200, I start not seeing the logic. 90% of the way up is, if you sold, is the same as 10% off the high. When it gets towards 100, then you'll see, it'll be really, it's not about the death of the dollar. It's not about devaluation. It's not about printing new money. It's all about the fact that gold is for war. China can make all the stuff that goes into AI. America's got a major problem doing that. So gold will go up, and gold going up will drag up silver and platinum and palladium and pretty much, anything in that way connected. You've got to be looking at the free flow. You see, most of gold is buried underground. It's never going to move. Even if it tripled or quadrupled, silver won't just, sit here or go down if gold's going to go another 1,000 or so. So that's what makes me think that it could go to 100 and maybe more. And, I remember when I was first time around with Bitcoin, and I'd made my 10x, and I'd bought Ethereum, and I'd made my 10x. And I sold it, and somebody on X or wherever it was came on and said, what are you talking about? What have you done that for? That's nowhere near. Ethereum has way more to run because it's like fast Bitcoin. And in the way silver is fast gold, it's the fast horse. So to an extent, I remember that as the fast horse, it should outperform gold, which is much, much bigger an asset. I mean, it's like a $50 trillion asset is gold. Silver's only a $3 trillion asset. And, it's one of those numbers I'm going to keep checking. Really? Only 3 trillion? I mean, that's a surprisingly small amount of money. So that's another thing that makes me think there's upside because, silver in all the world, all there is worth one NVIDIA. And, I can see that there's upside on that. I look at gold at 50 and go, well, that's the whole value of the whole American stock market right there. So, that's a weighty number to move up.
The fast horse argument sounds compelling, but markets have a habit of punishing simple analogies when liquidity tightens. As Clem Chambers points out, silver's smaller $3 trillion footprint versus gold's roughly $50 trillion valuation does create leverage, but leverage cuts both ways when positioning gets crowded. Nvidia alone recently surpassed $2 trillion in market cap, which highlights how concentrated equity capital has become rather than guaranteeing metals upside. Investors should note that past crypto-style multiples don't translate cleanly into commodities, which are constrained by industrial demand and inventory cycles. The real signal to watch is whether gold's move is driven by central bank accumulation or speculative flows, because only the former sustainably pulls silver higher. What Clem Chambers hints at next reframes whether this fast horse can keep running without throwing riders.
Although you've got to be looking at the free flow. You see, most of gold is buried underground. It's never going to move. Even if it tripled or quadrupled, America is not going to sell its gold out as Fort Knox. So that gold is stationary. So there's only a small free float to make the price move. So that's one factor to bear in mind. And to an extent, I think the same is with silver. But there's a lot of loose silver out there. There's a lot of silver tea services in antique shops and at auction. And, you see these silver tea services with knives and forks, 2,000 ounces for the price of the melt. So there's a fairly large amount of silver out there, but of course you can't really, that isn't going to be released in the short term. That takes weeks, months, many months for it to start to peter into the supply chain. So I just feel that there's more upside probability than downside. And I look at these things in terms of probability. So I would say I'm not sweating right now. I'm sort of scratching, itching a bit. And when it gets to 80 again, I will start to sweat, but I won't be selling. When it gets towards 100, then you'll see, it'll be really flooding off me when we're in the 90s.
Free float is the quiet driver most investors underestimate. And Clem Chambers has long emphasized that price is set at the margin, not by total supply. While global silver inventories exist in antique drawers and cutlery sets, recycling flows lag price spikes by months, meaning near-term supply remains tight. World Silver Survey data shows mine supply growth has averaged under 2% annually over the last decade, which limits fast responses. That's why volatility accelerates as prices approach prior highs like the $50 and $80 zones. Investors should recognize this isn't about certainty, but probability-weighted outcomes and emotional discipline, near round numbers. What Clem Chambers flags next matters even more for timing risk exits.
But I see the logic for 120. I see the logic for 200. After 200, I start not seeing the logic. But, there is some very interesting upside there. And therefore, I am hanging on in. And I don't like to do that. That's against my general nature to go in for every dollar of profit. Now, an interesting way of looking at it, and I've never really been able to do it myself because it doesn't suit my psychology. And that is, 90% of the way up is, if you sold, is the same as 10% off the high. So if you're brave and you've got the constitution for it, you can wait for the high and then sell afterwards, because it doesn't often come down like a rock. It tends to come up and then and make a couple of tops before, or near tops before it comes off. So if you're the sort of person that's really wants to hang on tough, you would wait for the high and then just sit around for a bit until you're sure that that was the high and then get out, because 90% is the same as 100% minus 10, isn't it? And some people actually do it that way. Personally, that's not for me, but that is one way of looking at it.
The most honest part here isn't the price targets. It's the admission that psychology beats math at market extremes. Clem Chambers has repeatedly warned that tops are processes, not moments, often stretching weeks as late money piles in. Historical silver peaks in 1980 and 2011 both formed multiple tops before collapsing over 30% within months. Waiting for confirmation sounds rational, but it assumes liquidity remains when everyone decides to leave together. Retail investors should ask whether they have rules before emotions take over in the 90s. What Clem Chambers implies next exposes why most people never execute this strategy cleanly.
Now, for those just looking at silver now, do you see that it presents still a good risk-reward ratio for those looking to invest and not maybe hold for the long term, but just kind of a short-term trade? Do you see that it still makes sense at this point to get in?
There's many ways of looking at this, and one way to look at it, which I've always hold in mind, I have these ideas. I don't believe 100% in them, but sometimes they're useful, and this is one of them, which is, if you woke up this morning and there'd been a mistake with your broker and they'd sold out your position, would you go back into it? Because that's the same as holding it. What's the difference, right? Oh, they sold me out at 72 and now it's still 72. Would you buy back in? Well, if you wouldn't, you should have sold. Yeah. So if I'm holding, I should say, yeah, why not? Why wouldn't you buy in at this price? So that's my thinking on that from a purist point of view. But I have another idea, which is if someone has to ask, the answer is always no.
This mental reset test is brutal because it strips away anchoring bias, something Clem Chambers often calls the silent killer of returns. Behavioral finance studies show investors hold losers 30% longer than winners, not due to logic, but emotional attachment. Asking, would I buy it again today, forces alignment with current risk, not past conviction. Short-term silver trades hinge on volatility tolerance, margin discipline, and position sizing, not directional belief alone. For portfolios, this determines whether silver is a trade, a hedge, or dead weight. What Clem Chambers hints at next draws a sharp line between conviction and impulse.
So if someone came to me and said, should I buy silver? I'll say no. Yeah, because you should never buy an investment where you don't know. You've got to, even if you're wrong, you have to intrinsically know. You have to have a very, very strong feeling to put your capital at risk. So if someone came up to me, all sheepish, next door neighbor bought a new car because he made money on silver, then I would say, no. You have to ask, no. If they came up to me and they said, I'm going to buy silver, I reckon it's going to 120, I'm pretty sure of it, and I'm going to put some money in, I would say, well, why not? Brackets, if you can afford to take a loss. If you're wrong, close brackets.
And you mentioned that what makes you convicted that silver is going to continue to run from here. One of the things that you mentioned is gold. You anticipate going to 5,000 or more. What are some of the signposts that are showing you that the gold bull market is not over as well?
Well, I've been saying for a very long time, and some people are starting to agree with me or see the validity in it.
This sounds harsh, but it cuts straight through one of the most expensive mistakes retail investors make. As Clem Chambers points out, conviction isn't confidence. It's clarity about downside, position size, and emotional tolerance before you ever buy. Behavioral data from Dalbar shows the average investor underperforms markets largely due to impulse entries driven by envy and headlines. Silver at 120 isn't the risk. Buying without a personal thesis is. If you can't explain why you'd hold through a 30% drawdown, you're speculating, not investing. What Clem Chambers highlights next reframes gold's role as the backbone of that conviction.
It's not about the death of the dollar. It's not about devaluation. It's not about printing new money. It's all about the fact that gold is for war. That's it. Gold is for war. And that's why countries are buying it. And that's why Wall Street has stood out of the way, because you can't fight governments. You can't short gold if governments want you to ship it in a lorry to Fort Knox. So you have to let the price run.
This quietly dismantles the media's favorite gold narrative in one move. As Clem Chambers has argued, gold doesn't surge because currencies collapse, but because governments quietly reposition ahead of conflict. Central banks bought over 1,000 tons of gold in 2022 and 2023 combined, the highest levels on record, with no dollar crisis in sight. Wall Street can fade inflation trades, but it cannot short sovereign behavior. That's why gold trends persist even when macro data looks fine. What Clem Chambers implies next explains why this demand is structural, not speculative.
And, I don't know whether America's buying any gold. I mean, it should do, really. I know it's got a lot of it, but nonetheless, China is certainly buying gold. Lots of countries are buying gold because gold is for war, and they see that tension is increasing. And it's because gold is for war, it doesn't mean countries are going to suddenly buy it when a war breaks out. They've got to think about it from now. I mean, when you've got Russian ships towing anchors around the Baltic trying to break all your internet cables, you can't just sit there and say, well, we'll wait till the missiles start flying before we buy gold. You have to start buying it now. And that's what's going on. Lots of countries are buying in gold into the central bank. It's not because the central bank wants it or needs it. It's because it's a strategic reserve for conflict. And if you feel that conflict is approaching, even if it's far, far, far away, the closer that conflict gets to you, the more gold you have to have in the vault. So you buy it in when stress is going up, and you probably sell it down when it isn't. And they're buying it in because the big deal, and there's lots of unpleasantness going on, as we all know, some terrible, terrible wars, but the big one is America versus China.
The market talks about inflation, but governments are quietly pricing in something else entirely. As Clem Chambers notes, China has added gold consistently for over 18 months, even as Western investors fixate on rate cuts. Strategic reserves aren't about yield. They're about resilience when systems fail, from cables to currencies. History shows gold accumulation accelerates before tensions peak, not after, which is why waiting for headlines misses the move. For investors, this reframes gold as insurance embedded inside portfolios, not a trade. What Clem Chambers points to next explains why this tension is still early cycle.
And, they're already going toe-to-toe in AI. And, AI is the top of the pyramid when it comes to conflict, because the smartest will win. And if America's smarter, then America will win. If China's smarter, China will win. And right now, China can make all the stuff that goes into AI. America's got a major problem doing that. So that conflict is real, it's now, and it's going to be rising and getting increasingly tense over the next year or two. So gold will go up, and gold going up will drag up silver and platinum and palladium and pretty much, anything in that way connected. Now, if I can add, on top of that, you've got this printathon, which is coming up, the Run It Hot, the re-industrialize the whole of America. Well, that involves printing a lot of money, and that will be inflationary. It won't be crazily inflationary. You won't be looking at 15 to 20% figures, but you will be looking at 3s and 4s and 5s, which is probably 6s and 7s and 8s underneath the hood. So we are going into an inflationary phase because they're going to have to print money for this AI, and they're going to have to print money for this reindustrialization.
This is where geopolitics, supply chains, and liquidity quietly converge. As Clem Chambers highlights, AI dominance isn't software. It's hardware, energy, and materials, where China still controls large parts of the chain. US fiscal plans tied to reshoring and AI echo post-World War II industrial spending, which historically lifted hard assets. CPI may read 4%, but real input costs tell a hotter story underneath. That's why precious metals respond before inflation shows up cleanly in data. What Clem Chambers connects next is how printing without collapse still reshapes portfolios.
So it's like I have to print. Now, the good thing is that money will be going into productive assets. Now, if you print money and put them into non-productive assets, up goes your inflation dramatically. If you put them into productive assets, like in the old days, railways, blah, 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 new factories, which will be new jobs, high paid jobs, AI infrastructure, etc. Well, that isn't anywhere near as inflationary as printing money and handing it out in food stamps. So it will be a massive printathon, but it won't necessarily be a massive inflationary driver, but it will be a noticeable and elevated inflation driver. And of course, that also drives all the precious metals, as we all know. So the theme of, the death of the dollar and all that stuff, while it's not going to happen, the inflationary theme behind it is going to be a thing. So you've got that, then you've got global conflicts, tension ever increasing. And, that can't be the end of gold's rise today. Maybe in 18 months, but not today. Not for another year at least.
This is the nuance missing from most inflation debates. As Clem Chambers explains, not all money printing hits prices equally. Capital spending stretches inflation over time instead of detonating it overnight. Post-war infrastructure booms saw steady inflation, but powerful commodity tailwinds lasting years, not months. That environment favors metals as long-duration hedges rather than panic trades. For investors, the risk isn't hyperinflation. It's underestimating how long elevated inflation quietly persists,